Occidental just posted $3 billion of free cash flow, its biggest print in nearly 4 years, and knocked another $1.9 billion off the debt pile in a single quarter. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Occidental Petroleum Corporation gets graded and traded. Alright, on the top line, revenue came in about 14% ahead of estimates, which is a big number for an oil company where the tape does a lot of the work. Realized crude prices jumped 38% quarter over quarter to almost $97 a barrel, and that just poured straight into the results. And on EPS, they reported $2.75 per share, roughly 28% ahead of estimates. But here's the catch. About 36 cents of that came from one-time favorable items, asset sale gains, derivative marks, discontinued operations. The clean operational number is $2.40, which is still a huge jump from the $1.06 they did last quarter, just not the plus 28% monster the headline suggests. So on the beat itself, and we're grading against those clean numbers, not the inflated headline, this earns an A. A double-digit revenue beat combined with clean EPS, more than doubling quarter over quarter, is genuinely strong, even accounting for the commodity tailwind. But on consistency, this lands at a C. Occidental Petroleum Corporation's track record of beating estimates is mixed. Their results move with the crude tape more than with clean execution, so any single quarter has a lot of noise around it. Let's talk about the positives from the report. The commodity tape did a ton of the heavy lifting this quarter. Realized crude prices jumped 38% quarter over quarter to almost $97 a barrel, and NGL prices were up 30%. That flowed straight through to oil and gas pre-tax income of $2.8 billion, up from just $1 billion in the first quarter. And that translated into $3 billion of free cash flow before working capital, which is their best quarterly print since the third quarter of 2022. That's real cash hitting the door on $4.6 billion of operating cash flow with only $1.6 billion of capex. This is the part I care about most. Management knocked another $1.9 billion off principal debt, bringing it down to $11.8 billion. And they still raised the dividend 8% to 28 cents a share on top of that. The debt milestone is $10 billion, so they're now within $1.8 billion of the target that unlocks more aggressive shareholder returns. Production came in at 1,433,000 barrels of oil equivalent per day, which beat the high end of their own guidance. Permian and Gulf of America both outperformed. So it's not just price. They actually put more barrels on the market than they said they would. And the midstream and marketing segment, which lost $87 million in the first quarter, swung all the way to $1.3 billion of pre-tax income. Crude sales timing and gas transportation optimization did the work there. So on profitability, this earns an A. Oil and gas pre-tax income nearly tripling, a segment turnaround worth over $1 billion, and the best free cash flow print in almost 4 years. That all lines up. Now, let's talk about the negatives from the report. Domestic natural gas realizations went negative, minus $1.48 per thousand cubic feet, versus a positive $1.01 last quarter and $1.33 a year ago. That's a meaningful headwind to their U.S. gas book, and it partially offset the oil strength. The reported EPS of $2.75 was inflated by about $364 million of favorable one-time items, roughly 36 cents a share. Asset sale gains, derivative marks, discontinued operations. The clean operational number is $2.40, and that's the one you should anchor to going forward. Debt at $11.8 billion is still well above the $10 billion milestone. Management is framing debt reduction as still in progress, which means free cash flow priority is going to keep skewing toward the balance sheet rather than shareholder returns for a bit longer. And here's the one I keep coming back to. This quarter's $3 billion of free cash flow was earned with WTI at $92.79 and Brent at $97. That is well above mid-cycle. Last year's full-year realization was around $64 a barrel. So if crude mean reverts, this cash story compresses hard, and you can't extrapolate the $3 billion into a run rate. And on the visibility side, the release gives you no explicit forward guidance on 2026 production, CapEx, or price assumptions. All you get is qualitative language about significant free cash flow growth by 2030, which leaves forward modeling almost entirely dependent on the commodity tape. So on guidance, this lands at a C-. Not because management is hiding anything, but because a release with no explicit production, CapEx, or price numbers gives you very little to hang forward assumptions on beyond a 2030 aspiration. And on red flags, I'm at a C. The commodity leverage is the real concern, plus the fact that the reported EPS needed $364 million of one-time help to look as big as it does. Those aren't deal breakers, but they're two things you can't dismiss. Putting it all together, this was a strong quarter, but the shape matters more than the headline. The clean EPS of $2.40 is the number, not the inflated $2.75. And the $3 billion in free cash flow was earned with WTI in the low 90s. So it's not something you can plug into a spreadsheet as a run rate. That said, the debt paydown and dividend raise materially advanced the thesis that Occidental Petroleum Corporation becomes a cash return story once they clear the $10 billion milestone. So I'm giving this print a B-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. My book is flat here, so instead of chasing shares at levels that already price in $90 crude, I'd rather sell cash-secured puts while implied volatility is still puffed up from the report. I'd set my strike meaningfully below where the stock is trading, because I want to survive a crude pullback and still feel good about the entry. The 8% dividend bump and the $1.9 billion in debt paydown tell me the underlying story is getting better, so getting paid to wait fits my patience here. So my play is simple: I sell puts and get paid to wait. When I'm writing puts here, I'm sizing for a world where crude drops from around $92.79 back down toward the $65 to $70 range that showed up in the 2025 realizations. That means my strike floor sits meaningfully below spot because that pullback isn't some crazy tail risk, it's a realistic case I have to plan for. I'd only pull my strike up closer to spot if I genuinely wanted the shares at that level, and the negative domestic gas realizations make me not want to reach for premium too aggressively. So I keep strikes low and respect the crude risk. I'm holding my shares here because the debt paydown to $11.8 billion puts them within $1.8 billion of the $10 billion milestone, and combined with the 8% dividend raise and production beating the high end of guidance, the ownership case is validated. The only reason I'd trim is if crude pushes materially higher and the tape starts doing more work than the actual operations underneath. On any oil-driven pullback that leaves the deleveraging story intact, I'd actually be happy to add to my position. So I'm sitting tight, the thesis is playing out. If these are my covered calls, I want to leave room for continued upside as debt drops toward that $10 billion milestone, because capping my shares at strikes that only look good because oil is cooperating right now would be a mistake. Any strike that gets tested, I'm rolling up and out to give the stock more room to run. I'd lean toward longer dated calls that let the deleveraging story keep playing out, rather than short dated rights that cap the balance sheet driven repricing. So I roll up and out, I don't cap the upside. My long dated calls just got stronger, not weaker, because debt is only $1.8 billion away from the milestone that unlocks more aggressive shareholder returns, and the dividend is already stepping up. The midstream and marketing segment swung to $1.3 billion in pre-tax income, which shows me the non-exploration parts of the business can carry real weight. The only reason I'd roll my strikes up is if crude does the work for me, and I want to lock in some of the delta gain. But the core thesis doesn't need any adjustment. So I hold the thesis is stronger, not weaker. If I'm underwater on a debt paydown plus dividend growth thesis, this print is exactly what I wanted. $1.9 billion of principal debt reduction in a single quarter and an 8% dividend raise. Averaging down makes sense to me on any crude-driven weakness that leaves the deleveraging trajectory intact, because the balance sheet is doing the heavy lifting. Cutting losses only makes sense if I thought this was an operational execution story, but this report clearly delivered on the balance sheet side. So I averaged down, the thesis was delivered. Bottom line, this print earns a B- from me. The commodity tape did a lot of the work this quarter, but the deleveraging progress and the 8% dividend raise are real, and they bring the balance sheet thesis materially closer to the finish line. Thanks for watching, and I'll see you on the next one.